Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for WealthPress. Today is Friday. It is the 13th of August. Man, it's Friday the 13th. Let's be careful out there. I'm a little superstitious. I mean, come on, right? You never know. Who could be sure? So we got a lot of global data. Not a lot of global data, actually. We had most data already happen this week. We had a lot of inflationary data, but let me talk about global data, then I'll talk about inflationary data. Japan, Thailand will report their economic activity for the second quarter this week. That's going to be really interesting in light of the fact that China will release its industrial output and retail sales for July. Now, this comes after the country's service sector was shown to have a rebound ahead of a fresh COVID wave. Folks, China is not doing well at all right now. Back in the States, traders worked through a mixed picture of economic data. Labor Department said jobless claims fell 375,000. Very normal number, totally as expected. Remember what I said, anything below 400,000 is kosher. This is completely kosher. At the same time, this is where the problem lies. Inflation at the wholesale level jumped a higher than expected 1% in July, matching the rise from previous month. Man, I hope this inflationary pressure is transitory. As far as the bond market is now trading below the 200-day moving average for the first time in about 2 weeks, 2.5 weeks. Now, this is really important, and that's telling us that the economy, or at least the bond market, is confident enough to feel that bonds are going lower and interest rates are going higher. Now, there was a little bit of, right here, we had a couple of tears where we were expecting maybe the Fed will cool off, maybe they'll cool off on doing anything. But no, they're more than likely going to take action, and I believe the bond market's going to go lower because there's an inverse relationship between the bond market and the stock market. Now, I want to talk about all the major sectors, kind of give you an update of where we stand. Now, financial, a little bit overbought. I think we're going to pull back maybe to the 37 level from the 39-ish level. I think it's a little too much too fast. I think this trend will pull back, especially in light of the fact that we're not seeing any major trends. Energy, I like how energy's holding up, and we've had two double bottoms. I think energy's going to break out. Keep your eye out on the 50-80 level. If we break above 50-80 on the XLE, there's a good chance energy will go up for another ride up. Utilities are overdone, just like financials. I think financials and utilities are just a little bit overdone. I like industrial stocks right now. This congestion, the sideways pattern, I love how we had a little false bottom here, but look how we bounced back. I think if we can get past the 106 level, I think industrial stocks are going to start picking up steam, full steam ahead. So I am pretty bullish on industrial stocks. The only sector so far, utilities and financial. And don't get me wrong, I'm still bullish on the financial. I just think we need to pull back. I mean, we had 1, 2, 3, 4, 5, 6 days of upside. And remember, the bond market's going down. Now, there is a inverse relationship between bonds and financials. If bonds go down, interest rates go up. If interest rates go up, it benefits financial stocks. So lower, this is why I'm so focused on the 20-year bond breaking the 200-day moving average and going down. And if we go down further, interest rates will go higher. The lower bonds go, the higher interest rates will go, and the more that'll benefit financials. I just think we need to pull back before going higher again. But utilities are a little overdone, especially right now with the market being at all-time highs. Healthcare I like this pullback. I think we're going to do another leg up. I think healthcare is prime right now, and I like how we're not really falling down. We're just kind of consolidating and moving down a little bit lower from the current level. So I like the healthcare sector. Consumer staples, I think, are going to pull back. I think consumer staples and utilities, I think we had a little bit of a fear with the inflationary pressure over the past few weeks, but I think that fear is subsiding right now. Now, the markets are grossly overbought in terms of large cap versus small cap, but that's not really impacting the sectors individually. So utilities, I think, are going to cool off, and I think consumer staples are going to go down to the 71 level or so. Now, basic materials, I'm liking basic materials. Yeah, I think they'll pull off or maybe go sideways for a few days, but I think eventually, if we can break this 88.60 level, I think basic materials are going to go up along with, where's my industrial? Along with industrial. Keep your eye on basic materials and industrial. They're like yin and yang. They're like Batman and Robin. They're best friends. Real estate. I like the real estate market. We're choppy right now, similarly to how we are on healthcare. Expect healthcare and real estate, both fairly defensive sectors, to kind of be choppy. I think real estate needs to chop out a little bit. We've seen a little bit too much upside, and the markets are rather choppy. So expect a little bit more choppiness and more trading range on the real estate sector. As far as technology, the numbers on our technology are just through the roof. They're really, really good, but we are so overvalued. So don't expect a major rally. Expect chop. I'm expecting real estate and technology to just chop and remain here. But volatility has not been increasing much, which means we can remain at these levels for quite some time. Consumer discretionary, same thing, maybe a little choppier. There's not a lot of correlation between tech and consumer discretionary. We're fragmented. So till we break out again on tech, you may want to stay out of tech. Communication, I think we're going to go a little higher. I don't see as much of an overbought level on the communication sector as I do on the technology. So and let me explain to you why. Let me show you this. See, if you look at the cumulative strength index, look where technology is and look where consumer discretionary is. And again, they should be next to each other, very similarly to how tech and communication is. So if it's a chip stock, like a total tech stock, like something that doesn't have any exposure to retail sales, like Amazon and Apple, it's a question mark whether that's a consumer discretionary or a tech stock. But like a chip stock, like Applied Materials, that's a tech stock. So tech stocks are good as long as they don't have any consumer discretionary in them right now. Now, in light of that, and in light of the fact that the stock market, I mean, I got to show you this. I've been showing this to everybody. Look at this. It's the same type of, look at that. We had this up, and then we had the divergence, and then same thing. Wow, let me change this study to 10 days here. There we go. So as you could see here, divergence. Notice this. Up, down, pow. Up, down. That's the question mark. And if you look at the mid caps, as I showed everybody in my VIP program yesterday, they're just choppy and directionless. Look at that. So you got to be really, really careful right now. And there's a good chance we're just going to go sideways, especially in stocks such as where is it here? Who moved my cheese? Where is it? Especially in stocks like tech, real estate, communication, and possibly, where's my real estate? And possibly real estate. So that's what I've got. But in light of this choppiness, there's a couple of stocks. Pullbacks tend to do really, really well during choppy markets. I got a couple of good pullbacks for you. And I may be repeating a few because I'm still liking them. So again, if I repeat a few from earlier in the week, that means they're still in play. American Waterworks, AWK, not a high flyer, right? Waterworks, industrial, basic materials, transport, simple stocks. Made swing high, pulled back to the EMA, didn't even go back to the 50-day. Real bullish. Looks like it's going to go up from here. AIRC, I've been talking about this. Apartment buildings. I'm into REITs that are apartment buildings because real estate, housing is getting too expensive. A lot of people are shifting focus into multifamily properties. So I like this right now. Next one, exchanges. If interest rates go higher, financial stocks tend to go a little bit higher. And Intercontinental Exchange is a trading exchange, and volume is picking up. And also, if COVID increases again and we go back to the stay-at-home environment, people go nuts trading the markets when they're locked in-house. And I like how it's pulling back to the 50-day line. And RSI, not overbought right now. Last but not least, Skyworks Solutions. I know this is a little bit of a tech stock, but again, tech is choppy. It's not bearish, and pullbacks work really well in choppy markets because you don't have a lot of directional volatility. So I like AWK, AIRC, ICE, and SWKS. Now, in light of all of this, before you go, I've got something important for you, something timely. Folks, the markets are vulnerable right now. And investors, they need to have a disciplined approach. That's what I always tell people, have a disciplined approach. And there's a lot of data to consider. But it's time consuming and it's easy to get lost, especially with rising COVID cases, high inflation, supply chain bottlenecks, and a fragmented market. Man, it's hitting us all from every side. What if there was a way to simplify trading? What if investors didn't have to waste time poring over reports, financial documents, and analyst opinions? Man, the world would be a better place. What if you could just toss all that stuff out? The financial reports, the analyst opinions, what if you could just toss it out? Well, I say you can. That's because all of those reports, they no longer matter. The only thing that matters is one simple line. And when a stock crosses that line, profits could soar. I mean, soar. Folks, the only thing that matters is one simple line, the sniper line. And I want to show you how it's done. Click on the link below and learn more about my Sniper Trading Pro service. Do it now. This is the time for sniper lines. We just banked a 90% profit in 6 days, for crying out loud. You don't want to miss this. And as always, make sure to like this video, subscribe to this channel. Folks, stay ahead of the market. Be the first to be notified when I post my next video with top pullbacks like this. Don't you want this analysis? Of course you do. And have a great weekend. Bye, guys. Stay out of trouble. Markets are choppy. And don't forget my sniper lines. I'll be back. Bye.